the tutorial should be more interactive, and so I don't know. So now there are somehow 12 people left. Oh
Yeah,
no,
some more
okay.
will join. So yes.
Okay.
So it should be
Yeah.
more interactive. Yes.
Yeah. Yes, but perhaps it's good just also, perhaps you should start like this, that what are the most important question you would have around mathematics, or what is somehow your wish, what you want to learn from the mathematical finance class. So basically I tried at the beginning, I tried to have the kind of a simple example, but it might be already that you are interested in different aspects. Huh? So everybody who has somehow subscribed to this class might have an idea what you want to learn. Just one statement, huh? One question, or what's the important thing you want to get from this class, huh? So that I can better adapt to your wishes. Huh? And of course, yeah. And if you have questions to the first lecture, please also go ahead and ask. You can also, just 1 second. Okay, I was joining here.
Yeah, it's visible. Your screen is visible, sir.
Yeah. So please, I mean, that's the disadvantage of online learning. Everybody's sitting in his office and thinks, okay, let another start with a question. Usually I would just take the first one, huh? Or the last one sitting in the room. Okay, I see here Manohar Sudhari. What's your main motivation to come to this class?
Yeah. So participants, our expert is discussing with all of us, and he wants that this sessions would be much more interactive rather just teaching, because it's a tutorial session. So if you have any particular questions about mathematical finance, what do you want to learn? What did you expect from this course? You may ask to sir. So one by one, any participant. So I mean, if you know something about mathematical finance, then fine. If you don't know, then you may ask the basic questions also. It's completely okay. So maybe you can tell what are the applications you have encountered in industry for this mathematical finance.
Yeah, so as I said, so the main concept is actually the pricing of the derivatives. So this was disputable actually until Black-Scholes formula was somehow invented or published, however you want to call it. Yeah? So the Black-Scholes formula was really a turning point, because then it was an objective way, yeah, to get a price on a derivative. Yeah? Namely, the price of the derivative is the cost of the hedge portfolio. This was the structural invention, yeah, of the Black-Scholes formula. So it doesn't depend on
Yes.
your preferences. Like in mathematical economy, before you were already talking about preferences, meaning you choose somehow your valuation of the state of the world. This means you have your own assessment of the probabilities, which was somehow depending on your risk aversion. Yeah, if you have how you weight large losses and so on. And so that's why this was called, it's still called risk neutral, and this was a common agreement. No? Now everybody uses Black-Scholes formula. No?
Yes.
So
Yes.
I don't know how you are related to financial markets. If you look in the newspaper, you get even prices of options. These prices are all somehow based on Black-Scholes formula. So, and that's why, let's say, people even say when Black-Scholes formula was introduced, like in the 70s, there was the first big crisis, because of course it's not good if everybody does the same. It's also not good for a market, as you might know. Might easily understand if everybody does the same. Of course, it's only one directional, and so also the 90, I think it was the early 90s, there was a crisis, which of course you might not know, which also came from applying Black-Scholes formula. But later it was somehow better understood, and the people know how to handle it. So, and also in risk management, for example, you have what's called sensitivities of portfolios or risk of portfolios, which are also based in all these calculations. There's somewhere this Black-Scholes formula. Not only for not only for call options, but for all other financial instruments. You basically use the same approach, which also gives you then, from a risk management point of view, actually risk managers want to have the delta so that you actually can hedge, that you just buy a certain amount of shares, which at the end is equivalent to holding an option. That's what the hedging portfolio is. And so for risk management, this means if you, let's say, under the assumption that the model is correct, you will have at the end of the option, it's fair. So the option holder has paid a price at the beginning, and the bank who gets this money from the option holder will use the money to replicate the portfolio, that at the to replicate the option, so that also the bank will have no loss. And the holder of the option, of course, has also no loss. He gets his contractual. And the interesting thing from a mathematical point of view, it's all set in a kind of a probability space, and that the market properties, like being able to hedge, being able to replicate, that's all you can read off from the probabilistic model, how you describe the market. And depending on this probabilistic model, of course, you have different hedge ratios. And so also in application, of course, later important to understand what happens if the model is wrong. That's what's called risk management. You take the sensitivities of the model, you hedged the same idea, you have an additional risk, not only the underlying asset, but other parameters become risky. So you take the sensitivity, the deltas with respect to the input parameters, like implied volatility. Who of you have heard about implied volatility somewhere, or market volatility and stuff like this? I mean, you somehow you read it in the newspaper that the market, okay. So this comes also, the volatility, the implied volatility is a parameter in the Black-Scholes model, basically. It's not a statistical measure. It's a kind of a parameter. And the volatility is, of course, also the mixture. It's kind of, so as a trader, you put in your assumption on volatility into a parameter, and then you get a price out of this. So this means even in how you quote prices is an implied volatility. So the trader doesn't tell you, I want to have 30 cents or 1,000 rupee for this option. He will tell you, I quote this at 20% implied volatility. Then you have to put it into Black-Scholes formula, and then you get the price. So that somehow we will come later to this. But so that's.
Sir, I'm having one question, sir.
Yes, please.
Sir, how can we predict implied volatility? How can we predict implied volatility?
Yes, we cannot predict it. I mean, the prediction, as I said before, it's not mathematical finance. Prediction is statistics. Then you have to take the implied volatility quotes,
Okay.
which
What?
are data.
Yes, sir.
And then
If we have data, then how we can predict that? Okay, this will be our implied volatility. So
okay,
so that
then
we can use Black-Scholes formula.
yes, I mean we can predict implied volatility by saying, okay, that's a time series, and we do statistics for time series.
Okay.
We then take it's a gauge model or whatever type of model this is, or it's an
Okay.
vector autoregressive model. Then it's coming to statistics,
Okay, sir.
and then which is called financial econometrics.
Okay, sir.
Yeah, of course, you have specific features of implied volatility from a kind of a structural point of view. You have entire surfaces. You predict a surface. So that's somehow the next step. First, you have to understand what is implied volatility. Yeah,
Okay, sir.
yeah, what is, I mean, for other statistical purposes, you sometimes want to predict a mean value. Of course, everybody knows what a mean value expectation is, or the volatility parameter in the normal distribution. We might also predict the distribution of prices. We actually don't. Then you do a
Thank you, sir.
statistical analysis.
Yeah, so sir, you can continue whatever you have
Yeah,
prepared for
yeah,
this lecture, and then students may ask the queries if they have.
yeah. Okay, so let me more talk about financial markets. This is a tutorial where we look at certain products in a little bit more detail. So let me just recall the last statement. That's a replication idea. So that's
Yeah,
what,
yeah,
the replication
yeah,
idea, and that's fundamental for the pricing. And in the theorem, we have one specific model where we have an explicit formula on how to construct the hedge portfolio. And so the value of the option is also the value of the hedge portfolio. Now, so the implied volatility actually I don't know. No, okay, that's fine. Yeah. So this is kind of numerically or technically however you want. Yeah. So we will try to understand, which I tried to explain already, why this is a reasonable formula, this complex formula, V0. Yeah, you make this induction and you end up at V0. Yeah, and V0, that's the option price. You get it by numerical procedures. And so let's now talk about financial products. Okay, the simplest financial product is what's called forward and futures. Here you agree on a forward price. That's mean our BioNTech share. You don't want to buy the share now. You want to buy it in 1 year. And then you agree on a price like this, 150. Then actually you also have to buy if the price is at 100. Then you take the loss. So this contract, put it like this, there's no optionality. You have no option to execute or not. So you have to buy at the forward price. You see the forward payout let's say it's a time 1 year. So your payout, let's say it was 100. Yeah, if the price will be 100, sorry, if the price equals 100, yeah, you have no loss. Yeah, you buy it at 100 and you sell it at 100. So there's no, or you book it at 100, there's no gain and loss. Huh? Yeah, if of course the underlying asset will be above 100, like at 120, you will have a gain of 20. But in this contract, you also have losses. Huh? If the value is 80, yeah, you will have a loss of 20. Huh? No, that's a non-optional character. It's a fixed contract. You have to buy at 100. Even if you get it cheaper in the market, you have to buy at 100. Then you make a loss because you get it cheaper. Or if you are lucky, it's getting to 120. Then you have 20 gain. Okay. And then now we come to these options. And I said to the option, so you have an option to do something as a buyer. You have bought an option and now you can relax and you can see what happens. And like in a call option, where you have the right to buy, you will only buy if the price you have agreed, your strike price, is lower than the market price. Because then you can immediately make money. You buy it at 100 and you sell it at 120. It's a price, like in the bio. So there you also have a gain. The put option, then you can sell. This means you sell an option, and that's good if the market price is low. I show you the what's called the payout here. These are all the payouts of a call option. Our K equals 100 all the time, which we had before. As I said, if the underlying price is above this, you make a gain of 50. It's here. That's your gain. A call option is different because you can sell. This means if the price is like 50, your bank has to buy it at 100. You can sell it at 100 to your option counterparty like the bank. So this means you will go to the market, buy the underlying of 50, sell it for 100 to the bank, your gain will be 50. So if the price is 150 and you can sell it for 100, you won't execute. Because in order to sell it for 100, you have to buy it for 50 at the 150 at the market. You would lose 50, so you don't do it. You have the option not to sell. So this means, from a strategic point of view, you only buy a put option if you think prices will go down. If you think like BioNTech share will be low next year, there's no reason for you to buy the BioNTech share now. But if you want to make money and you are convinced that it's going down, you buy a put option. Because price will be lower than today, so you will make a gain. Any questions to these options? Have you ever seen an option like this? And so these payout functions.
some of them might have done the course on mathematical financiers, so they might be knowing this payoff function. But
Yeah.
yeah, I know a few participants, they know about this payoff function.
Okay.
So they must be getting what you are conveying to them.
Okay. Yeah. So this means as an option trader or as investor, you sometimes you have opinions. Yeah. You would buy a call option in order to make money from increasing prices. And if you are pessimistic, you are convinced that this specific share will go down, and you still want to make money from this share, yeah, you buy a put option on this share. Huh?
Yeah.
Huh? And of course, there are
Yeah.
many others. Yeah? These are the simplest one, and you have many underlyings as well, as you see in the later slides. You see here underlying equity shares. We basically talk here about shares, yeah? But of course, interest rate, actually the largest market is interest rate markets, currency, indices, yeah, and so on. Indices of bonds or indices of shares. Yeah? So it's
So, sir, I
tremendous
think it
amount.
will be good for us if you just please explain a bit that how derivatives are written on interest rates and currencies.
Okay,
I mean, we do understand on equity and shares that, and in India also it is very popular, the derivatives on equities and shares. But if you please explain us a bit that what is the role of derivatives in when we take underlying as interest rate or currencies?
Okay, so then, okay. So an interest rate, the simplest one, yeah, if you have a financial instrument like a bond, yeah, you know, a bond, the present value of a bond depends on the interest rate. Let's say you have usual bonds are kind of fixed rates. Yeah, you get every month, every year, you get 10% interest on 100. Yeah, so your cash flow is you pay 100 at the beginning. Yeah, you get 10. Let's say 2 years, 10, and then you get 110 at the end. Yeah, with all these cash flows, which are called in one of the slides just deltas. Yeah, yeah, this is 1 plus R. Yeah? This is R, sorry, R 100. Yeah? So this means that's your cash flow. If interest rate goes down, yeah, you make money out of this. Yeah? Because if, let's say, this means here R was 10%. Yeah? If interest rate goes down, yeah, if you would make the same contract giving you the nominal back, yeah, interest rate is 5%. This is a very valuable. So R goes down, bond goes up. Nah? Because if you would do the same contract in year one, next year, and you won't only get only 5 all the time, yeah, this is more than 100. Here it starts with 100. And scenario where bond, it's actually more value than 100. Because you get these high interest rates. Contractional cash flows 1 year ago. Of course, if interest rate goes up, bond values go down. How is this? For interest rate, you first have to understand what the product are. This is a fixed coupon bond.
Yeah.
Okay, and the volatility here, or the uncertainty, is about the interest rate. Uncertain interest rate. Yeah? That's why in interest rate markets, even you have these bonds to trade, or the derivatives, okay, you have also bond call and put option, but then the same as equity and shares. Yeah? Only the risk factor is it's different. The risk factor is interest rate, but you have to price each time. There's a formula how to get the bond as a function of the interest rate. Huh? Okay, but let's say we just concentrated on interest rates. Huh? The rates. Huh?
Yeah.
This means first rates
Yeah.
are somewhere in, let's say, in 0% up to perhaps 20% at most. Yeah? You see that
Yeah.
it's quite a different feature than equities. No? But your
Okay.
interest rates is like this. Yeah? If you want not to have these losses here, you buy what's called a cap. At 10%. This means if interest rate goes up to 15%, you get the 5%. So the interest rate goes up and down. And each time it's above 5%, above 10%, this bit is paid to you.
Okay.
This means what you agree, that each time you have a loss, basically you think you have this bond as the underlying, and each time you lose too much on the bond, this loss is given to you. So this means already, as I said, the function which gives you the cash flow from the underlying risk is becoming complex. In the interest rate, a cap is even a portfolio of single options. What in the single options are called caplet, because here I have an option on 10%, here I have an option on 10%. And each year, if I have to pay interest, or if you have a new interest in the market, new interest rate in the market, you get some money back from your cap counterparty. It's capped.
Okay.
You have a cap on this one. And this is a caplet. And the caplet, that's one cap on a bond. Or cap on interest rate. It's actually the put on the bond, but you see already the formulation of this F. It's much more complex. It's like you have many interest rates, so it's a sum of running interest rate minus, let's say, 10%, written on a nominal, and then discounted by the interest rate. So the formula for the cash flow you get from a cap, each single part is like a option plus, like a cap, like a call option. Actually, it's a put option, but okay. So it's a put option on the bond, so a call option on the interest rate. So you have the caplet, is the product which is traded. It's a cap, and the cap is already a series of caplets, and each caplet is like a call option.
Okay.
And the other one is a floor. So you will always have a higher than, let's say, 2%. You always earn more than 2%. You get an interest, you get the cash flow such that the interest rate is always above 2%. That's what's called the floor. and it consists of floorlets. That's why usually interest rates to cover in lectures is not so easy. Yeah. And in addition, there's not a single interest rate. You have for each maturity, you have another interest rate.
Sir, I have one question. Excuse me, sir.
There's this.
Sir, how this uncertainty in interest rate can be handled in practice, like in some in cases like Black-Scholes or other cases, the interest rates are constant, but here the interest rate are uncertain. So how can this be handled in practice?
Interest rate. So the interest rate models in practice are quite complex. Yeah. So because interest rate models, how do I get a plain? It's a very different. I mean, equities are simple. Interest rates are complex, whereas the ideas are the same. So because in interest rate you have to model an entire curve. Okay. So how do I get a blank page? Let me go up. I go to here, I have some space. Okay, so the simplest interest rate model, if you want to see it, so you have a bond at time t. So this is a contract, which gives you one currency. At time capital T, it gives you one. It's not an option, you have to value it. Okay. Your assumption is that this is driven by an instantaneous you have your discounting from T to T. And that's your risk neutral probability. Yeah, as you said, now the randomness is in the interest rate. RS, this one is a stochastic process. Yeah, so this is a principle we have developed in our markets. Yeah, here's one. Your payout. Your payout is simple now. So that's your. It was delta t before or vt, however you want to call it. Yeah, that's your option at time t. It's a contract, which is for certain. You get $1 or one currency unit at maturity. That's called a zero bond, zero coupon bond. Now that's the simplest contract you can have. Yeah? So your government will give you 1 rupee in 1 year. Yeah? For this, you give your government now 99 cents. From this, you can calculate the interest. Okay. And then you have, this is stochastic because you don't know the interest rate. That's an artificial, this is not traded. RS is not traded. RS is now a risk factor, put it like this. Namely, we take it very simple, it's just one instantaneous interest rate. So RS is somehow, if you lend over 1 second, which you never do, it's a mathematical construct. But you know that if you do it all the time, you get this exponential form. Because you multiply each second, you get this integrated exponential form. And all your pricing, all interest rate models start with this products and with one interest rate model. Interest rate model is typically denoted by this one. It has parameter theta. it has parameter kappa, and it's different. It has a kappa here, with theta ds plus the simplest one is you have just a Brownian motion here. That's called, if you want to read it up, that's called the Wasicek model. That's like Black-Scholes is the most simple one in equity and the Wasicek model, that's the simplest one in interest rate. Yeah? But you see, it's already much more mathematics behind it, yeah? Because you already know, yeah, you have digested and believe it, and you have a risk-neutral probability, yeah, yeah, and this is under P, yeah, under P. Yeah, you get different parameters as we have our P star before, we have now K star and theta star, which gives us a risk-neutral probability. Huh? Okay, from this, you price all other products. And you get this one because you get quotes on so this is a basic property, Wasicek model for interest rate models. Of course, it's much too complicated, but you get never a Nobel Prize for interest rate model. Because the economists, they don't understand this anymore. So this means you have basically what you have here at each time t.
Yeah.
You have an entire curve. Mathematically, this one at time t is an infinite dimensional stochastic process. So t, because this you get for every time, for fixed time t, running time, like today, tomorrow, in 1 year, you get for each larger time, like today, tomorrow you can buy a bond for the day after tomorrow, you can buy a bond for next year, and so on. No? So this means you have this one. This is a random function. The interest rate curve. Because for each capital T, you get now how the layman would say, okay, actually, what I use this as I discount my one, which I get later by a rate which depends on running time and finite time. But this one is random. Here you have an omega, here you have an omega, and here you have an omega. Also today, you have an entire curve. Your B0t, you actually have for h for each t larger than 0. Your initial condition is infinite dimensional.
Yeah.
So this is a function. So that's why it's much more involved. But that's why it's not useful to start with interest rate theory, because I mean that's hopeless. We start with one. Here you have, if you like, an market which consists of arbitrary many assets.
Yeah.
But basically, you can all put it down to one, not an asset. Let's say in risk factor, where you assume in your model all assets are driven by this one risk factor, but in a complex manner in terms of conditional expectation. But that's applied in practice. Yeah, that's really applied in practice.
Am I audible?
Yeah.
Yeah, please.
sometimes it's difficult to analyze this financial model, but how we try to understand this financial model? What is the physical sense behind all those models?
Sorry, do you want to have a physical model?
Yes, sir. मतलब how relate those model to our financial market? What type of situation occurring so that we are using such models?
You mean to the financial markets?
Yes, sir.
Yeah. He is interested to know a bit in of financial markets.
Yes, so this one you see in the market. Huh? Today you
Yes,
see
sir.
it. These are the interest rate curve.
Yes, sir.
Yeah.
Huh? I don't know what's your Financial Times interest. Let's look at the Financial Times interest rate curve. I don't know how it's. Huh? What do we want to quote?
Maybe you can open in the new tab, sir. Otherwise, this PDF will go.
Yeah. So this is just one curve. It's in no. It's called interest rate curve. Yeah? So that's called a yield curve. Yeah, so this is it's also simplified, yeah, but this you can read somewhere in the newspaper. Yeah, that you get a curve like this. This tells you, okay, if you lend for 5 years, you get 3%. If you lend for 20 years, you get 5%. Yeah? This is yield curve itself. It's not the B, yeah, because this is a zero coupon curve, zero
Yeah.
rate curve. Yeah, here's one. Huh? So this is zero. This okay. That's also you want the one in the newspaper. I don't know whether I find one in financial.
Yeah, it's okay. It's okay, sir. Yeah.
Yeah,
These are the
even
curves.
this is
Yeah.
produced. Yeah, but this is sorry. So you see, this is a curve. Yeah. So this tells you, yeah, if you lend nowadays, you see that's more realistic for 5 years. Yeah. You have to discount it by 5%. Yeah? If you lend for 10 years and don't get coupons in between, you just get at the end, you get your nominal back. Yeah, it's 5.4. And so this one are the forward curves. This means if you lend, I don't know, 1 year from year 1 to year 10, year 10 to 11, you see the forward curves are always higher. There's the discounting. If you lend in year 15 to year 20, it should be specified which is a forward horizon, like 3 months, 5 months, or whatever. But these are the objects which you see in any finance paper, finance newspaper. If you look at this, you find these curves telling you the interest rate curves. But of course, next day they will be different. So this is, in terms of probability, a stochastic processes, which has certain properties and certain arbitrage simulations and so on. You see, and this is the object of the interest rate market. Interest rate at any maturity. You lend for 5 years, you lend for 10 years, or let's say you invest, let's say point of view, you buy bonds from the government. Nowadays, if you buy a 5-year bond, let's say you pay 100. So you pay, if you pay now 100 to the government, you buy a contract with the government that tells you, okay, I give you back 105 in 5 years, you pay now 100. And how
Yes.
this interest rate is, or the discount. For this, you need to know discounting, our interest rate. This one, you understand? 5-year interest rate here. I know I can put it not here, but you see. Yeah. That's my. So your BT, the interest rate is always like this. Your interest rate bond, let's say for 5 years, it's always this 5-year rate you have seen here, and then you have 5 times the 5 years interest rate. You discount exponentially. It depends. I mean, if you want really to go in discounting, like just these are all like particularities. Like in 1 year, everything in 1 year, you take geometric discounting. If t is smaller than 1 year. If it's over 1 year, you take exponential discounting. And that's how they are quoted. And that's just the convention how you discount. So if here it's your 5-year rate, 5-year. So that's why it's, so let's say your 5-year, in this case, 5-year rate equals 5%, meaning 100 times E of minus T times 0.5 equals current price. Yeah. So this 5% from this picture, I have done it. 5-year, 0.5%. This tells you if I have now a contract where the Indian government gives me 100 back in 5 years, I now pay. This is actually 5 years. Because we are in a tutorial, you tell me the price.
Yeah.
Any
I hope
quotes that
it's
you
clear
also have to
the-
work tutorial, you have to work. What is the price of a 5-year bond according to this yield curve?
that they should calculate. Yeah. But so participants, you should also
Calculate this one.
those who know a bit theory, yeah, they can calculate and they can. Those who have done some course on this and those who have who are having some idea, they can tell.
So what's the current price? Of the contract, government gives me back 100 in 5 years, where we know that the 5-year zero rate is 5%. So everything is just 5,
Yeah.
except the price. So what's the current price? Any proposals?
Anyone, you can calculate from this expression.
You can use
So,
use your mobile phone. It's now allowed.
Yeah.
It's officially
just
allowed
to
to use your mobile phone.
just to implement, just to multiply those exponential and the S0. I think they have not the pen and paper with them, so they are.
No, I do it now myself.
Okay, sir. Yeah.
Any proposals? This is a tutorial, so you have to work.
77.88.
How much?
77.88.
77.28. Okay. Huh? 77.28. Huh? Huh? This means you give now 77.2.8 to the government, huh? And he will return you at the end, after 5 years, he will return you 100. Huh?
Yes.
Huh? So that's how prices are related to interest rates. Huh? Actually, the current price, because it's a yield curve, just to show you it's more complicated. It's exactly what I've written down before. Yeah, you get 5. Today, you get 5 in 1 year. So this would be in the first year. Then you get another 5 in the second year. Plus, and in the last year, you get the 105 E2, because it's a yield curve. Yield is not the zero curve. Huh? That's why in interest rate you have to be careful which rates you are considering and so on. And you have to do different discounting. It's always, so that's how you calculate it here. Okay, that's interest rate markets. And so, of course, so the most, so this is a Vasicek model, but the most important model, and if you look up what's my research area, is actually you have a different volatility structure. You have the same drift. That's a CIR, Cox-Ingersoll-Ross model. Because the simple one, which have you seen before, the interest rate can become negative and highly negative. This model is always larger than 0, so it's at least if you believe interest rate is positive, that's a better model for interest rates. That's our R. Sorry, that's the R. That's the Cox-Ingersoll-Ross model, and that's also, I mean, I'm currently talking about the Cox-Ross-Rubinstein model. So that's a binary model. That's an educational vehicle or a numerical vehicle. But Cox and Ross, they also invented the next level, the second most simple interest rate model after the Vasicek model. But here already have a complex diffusion term. So the diffusion term becomes more complicated. But let's look at this, because you are a mathematician, and you don't like probability. Who likes probability? Okay, even if you don't like probability, considering this equation, How this is equation you might have somewhere in calculus 2, or I don't know how you it's written,
Yeah.
What about this equation? Who knows this equation? How it's called? It's now a differential equation. How does the solution looks like? An ODE, no stochastic and nothing. Everybody have seen it? Like in even
Yes.
application in biology, yeah? And how does the solution looks like qualitative? RS, who is RS, who said yes? Mr.
Yeah,
RS.
some student. I think yes, Mr. Ram Sagar. He said yes. Yeah, yes.
So how does it look like?
So its solution looks like exponentially.
Yeah.
What exactly it will be? Do you have any? I mean, do you remember that?
Have we seen it? No, just qualitative. Yeah. We have seen this already. I showed you. And I'm just looking for
Yeah.
this. When I explained you caps and floors,
Yes, sir.
probably it's gone. You see it. It doesn't save it. Okay. It's going up and down. So this model, okay, under important assumption, like here's a minus, if you like, kappa negative. It goes up and down. And it's concentrating, it's going always down to theta. It's a logistic equation, and it's always mean reverting. Speed is with kappa, mean reverting to, it's mean reverting to theta. That's like interest rate behaves. It's very different from share skills goes up. Interest rate go up and down. And then you have some noise around this. Okay.
Yes.
Yeah. Oh, they are mean reverting. That's a mean reverting long-term level, it's called. And that's a mean reverting speed. A mean reverting speed. And then you have noise around this, because you don't know exactly where it's here. It's always noisy. That's why you are risk. You have risk. You have to finance it, find money you just need for taking risk. Of course, people think they have money for investing, but basically you need money. You need the accumulation of capital to buffer potential losses. That's the only moral, ethically reasonable reason why we have money, why we have to accumulate capital to cover the risk from the future. It's not for the personal richness or whatever. It just you have a capital buffer in case you fail. And that's why you need prices for. Okay.
Yes, sir.
Further questions?
Yeah, I think we have discussed in great detail this derivatives on
Interest rate. Okay.
interest rate.
Yeah.
So a bit. Sir, do you want to take a break of 5 minutes? Because we can take a break of 5 minutes and then we can start again.
Yeah. Okay.
If you
Then
wish.
we can start again in the 5 minutes. Yeah, that's fine.
Yeah. So Yeah, that will be great because it has already been 1 hour. I request all the participants to please be online. Do not leave. We'll be starting. Just take a break of 5 minutes and then we'll again start.